Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is part 5, the final part of my 5-part series on fairly valued dividend growth stocks. I'm kind of excited about this final part because these are really true dividend growth stocks. These are among the fastest growing of the 50 stocks that I've shown you. So you're going to see some pretty good historical performance here. My first research candidate is Snap-on Incorporated. It's a company I really haven't looked at in a long time. I used to think of it as Snap-on Tools. It makes industrial machinery, tools, and a lot of other products like that. And again, just to get everyone refreshed on the FastGraphs research tool, I'm starting with a plotting of operating earnings per share here. And I'm going to stick to operating earnings since I've got to cover so many companies. But I do want you to be aware that there are 5 or 6 other metrics that I also always look at when I'm analyzing a stock. But anyway, you see operating earnings per share. You see a down year in earnings. Earnings fell over 43% for fiscal 2009 coming out of the Great Recession. But one of the things that strikes me that I'll talk about more is how that we saw this acceleration in growth, and that's very important when it comes to valuation. Earnings growth has been 11.2%. The company is currently available at a 13.8 blended PE ratio. It's A- rated, only has 22% debt, and it's about an $8 billion company. So I'm going to now put the graph together. Let's start by adding monthly closing stock prices. And what you'll see here on all these candidates, you'll see a relationship between price and earnings at this valuation level. This orange line is a PE ratio of 15. So when I put price on here, you see a clear relationship between price and operating earnings, but you also see the occasional disconnects where the stock trades below its earnings justified valuation line, and then periods of time where it's gotten dramatically above. But this is kind of anomalous. I call this a tool to think with, and this is going to be a good example to help you understand that a little better. The next thing I'm going to add are dividends while they still belong to the company. This is the dividend line, the white line. The area below it is the dividend payout ratio. I want you to notice that when earnings were kind of weak back here in the mid or early 2000s, we saw some very high payout ratios, but more normally we see a payout ratio about in the 20% range. Then I like to stack dividends on top of the orange line to illustrate that this is when they belong to you, the shareholder. This is while they still belong to the company. But the next thing I want to look at, I want you to notice we have an 11% growth rate. We have a little bit of high valuation here and a little bit of undervaluation. So when I look at the long-term performance that you're going to see here, it's going to relate very closely to this 11.2% earnings growth adjusted by some of those valuation anomalies. And you see that capital appreciation was 9.4. That's a function of a little bit of overvaluation in the beginning and of course a minor undervaluation currently. The company paid more dividends than the S&P 500 over this time frame and had a significantly higher total annualized rate of return, 10.4% for Snap-on versus 6.4% for the S&P. So what we see here is a very interesting long-term growth stock. There is some cyclicality in the earnings along the way, but now I want to shorten this to an 11-year graph, and I want to focus on what we see happening here. And this is why I call FastGraphs a tool to think with. Watch what happens to the earnings growth rate when I shorten the time frame down here to a 10-year graph. The earnings growth rate now jumps up to 18.4%. And since this is above 15%, like I talked about in the written portion of the article, I'm now drawing a fair value reference line as a PE of 18.4 or a PEG ratio of 1 equal to the earnings growth rate. And we now see that the company does not look as overvalued as it did historically. Now here I've changed the time frame once again because there's a very interesting lesson in valuation here that I want to illustrate. If you look at Snap-on, now I've got a 17.7 PE. So what I want really trying to illustrate here is that the research tool to think with is adjusting when you draw different time frames. So now we've got a fair value reference PE of 17.7, but I want you to notice that at the end of fiscal year 2015, the PE ratio was 21, which is significantly higher than its current PE. If you'd have bought Snap-on at that point in time and held it through yesterday's close, you would have lost about almost 15% of your money. You would have received some dividend income, but you still would have had an annualized negative rate of return of 4.9%. But here's what's interesting about valuation. Had you waited a couple of months and bought this stock in February of 2016, when it was trading at a PE ratio equal to its earnings growth rate, or a PEG ratio of 1 in this case, and held it to yesterday's close, and there's a bit of an optical illusion here, I want you to notice that you would have made about $100 in capital appreciation. The price went from $144.67 to $146.17. So you got very very minor capital appreciation here. You got the dividend income, and your total annualized rate of return is now 2.4%. That's not a great annualized rate of return, but considering the fact that you bought it at fair value, you didn't lose any money, even though the stock is now currently undervalued. Valuation is critically important. Now I want to talk a little bit about the future on this company very quickly. There are 8 analysts that are forecasting an average of 11% growth, 14% for this fiscal year, and around 8% for next fiscal year. This would mean that the rates of return over the next couple of years here would be very exciting, over 30% by this year, and that's assuming the stock trades at a 15 PE. That would only be modest PE expansion, and by fiscal year end 2019, an 18% rate of return. I get a lot of comments about people saying I spend too much time on history. This is forecasted growth. The analyst scorecard for the record of analysts over the last 5 years has been batting 100%. So this company has been either giving really good guidance or it's relatively easy for the analysts to analyze, and I can see why. It's A- rated with only 22%. My next research candidate is J2 Global Inc., a sub-industry internet and software services company. I'm only drawing the time frame 2003 because if I go to prior years, the company actually had some negative earnings growth, which kind of skew the data. But since 2003, this company has grown at 20%. Therefore, the earnings line is a PE of 23, the orange earnings line. The normal PE has been a little lower at about 16.8, but this gives you a nice range of valuation. Note that the company only started paying a dividend in 2011. Nevertheless, thanks to this high rate of growth and dividend income for about half the time frame here, we see an example where this company dramatically outperformed the S&P. Again, note that the capital appreciation was very highly correlated with the company's earnings growth rate, and even though it only paid dividends for a short period of time relative to the S&P, it paid significantly more dividend income, given a 21% return versus 8.7. I think the stock is significantly undervalued at this point based on historical numbers. But even looking forward, there are 8 analysts forecasting about 9% growth going forward for the next couple of years. The longer term growth rate, however, by 3 analysts is about 13%. So I think this is a very attractive growth stock. It offers a 2% current yield. It's BB rated, has 49% debt, and looks attractively valued at today's levels. My third research candidate is the grocery store food retailer Kroger, and there's some really interesting examples of the importance and lessons in valuation, if you will, with this company. We noticed that the stock was very highly valued back in 1999. We had PE ratios up in the 50s. The current PE ratio is 12.4, and of course that led to an extended period of time of very poor performance. I'll calculate it here for you real quickly. From kind of a peak to trough here, you would have lost over 40% of your money holding Kroger from January 1999 to 2005. But once the company became attractively valued at any one of these time frames, even though it's undervalued today, you would have averaged over 10%. But once again, the thing that I liked about showing this particular graph was that you see periods of significant undervaluation followed by, very hot period in the market here where the stock got overvalued. And then we saw the inevitable, not only reversion to the mean, but the overshooting of the reversion to the mean. Then the stock came back to fair value and it's currently undervalued again. It has had relatively weak performance over the last couple of fiscal years. However, looking further out, there are a rather large group of analysts, over 20 analysts, forecasting earnings growth of about 8.7%. We get back to a normal PE of 15 like I talked about in the written portion, and you've got very attractive rates of return here. Now, looking at longer term, there are 5 analysts that think the company is going to continue growing at about 6.37% going forward. So again, you've got double-digit return possibility here. The company offers a 2% dividend yield. It's BBB rated, 53% debt. And keep in mind that the grocery industry is a low-margin business. I also want you to notice that the company only has been paying a dividend since 2007. And so I'm going to shorten this time frame where we buy this stock at fair value and look at historical performance. And you can see that when the stock was in reasonable valuation on its fiscal year end of February of 04 and held to yesterday's close, it underperformed the S&P on total income, outperformed it on capital appreciation, and moderately outperformed it on total return. So the real key is buying it at an undervalued level like now. The potential rates of return going out for the next couple of years, as I've already talked about, would be excellent. I think Kroger looks very attractive here as an undervalued kind of a conservative food retailer. My next research candidate is Royal Caribbean Cruises, obviously the cruise line, Hotel Resorts and Cruises as it's called. I want you to notice a couple of things here. Pretty flat earnings, and I want you to see these related relationships between price and earnings. It's critically important that you get forecasting earnings correctly when you're looking at anything like any kind of stock, whether it's a dividend growth stock or a growth stock. We had a significant drop in earnings coming out of the Great Recession. The company completely eliminated their dividend for a couple years. They started paying one again in 2011. So let's go ahead and shorten the time frame a little bit. You see we've got really exceptional growth rate. But here's an example where, because of possibly, and I'm only speculating here, that we had such historical poor performance coming into the recession, the market has been valuing this stock at about an 18 PE, even though its earnings growth has been over 27% per annum. Nevertheless, over this time frame, Royal Caribbean dramatically outperformed the S&P 500 on a capital appreciation basis almost twice, and still actually was able to generate slightly more dividend income. But the total return of 21% versus 12.5% for the S&P over the same time frame correlates very closely to the company's earnings growth rate. I think the stock is undervalued currently. Forecast growth by a large group of analysts for 2018 and 19 looks very, very attractive. The longer-term growth rate is estimated to be almost 15%. This provides the opportunity for double-digit rates of return. All we got to do is get back to a 15 PE and have these earnings manifest. The company's earnings scorecard is decent, but they have missed earnings forecast 20% of the time. And I think looking at that, it's been a long time since they missed a forecast. That was in 2013. Otherwise, they've been pretty much on the money in more recent times. My next research candidate is Tractor Supply, kind of a Royal specialty retail store. I find this one very interesting for a couple of reasons. First of all, I want you to notice the company's growth rate historically, going all the way back to 1999, has averaged over 18.8%. And you can see how closely stock prices track that. But what's really interesting about this stock, and this is kind of something that can happen when you're buying dividend growth stocks, I want you to notice they instituted their first dividend in 2010. Their payout ratio looks like about 25% here. We can check that very quickly by going to performance. And it's been about 25 to 30% in more recent years. But here's what I find interesting. Even though this company has only paid a dividend since 2010, because you bought it at such a low valuation, the company was trading at $1.50 a share split adjusted in December 31st, 1998 when this above graph was drawn. Nevertheless, because you bought so many shares, almost 6,666 shares, you received a significant amount of dividend income. It dramatically outperformed the S&P. Obviously, capital appreciation correlates very closely to its earnings growth rate. But what's interesting about this, in my opinion, is how a growth stock that morphs into a dividend growth stock can even generate substantial income. This is why I suggested in the written portion some of these stocks would be, better for people nearing retirement. But even this particular candidate would have been a great stock to have purchased, many years ago when you were young and held over all these years. But once again, you see the effects of a high valuation. You see how overvalued the stock got in 2015 and how that eventual reversion to the mean. However, today, I believe the stock is moderately overvalued to fairly valued based on the fact that there are over 20 analysts forecasting about 14% growth. But because of that high growth, this would still be a positive rate of return, even if the PE fell to 15. However, if we go back to that normal multiple, and I'm going to choose a little more benign multiple here, you can see the historical PE ratio of this company is averaged in the 20s. So I'm going to pick the lowest one here that the market has historically valued at. You can see the rate of return this year would be exceptional. Rate of return going out to 2019 would be over 30%. And if it was able to achieve all this and still trade at a 21 multiple, it would be over 22%. I consider Tractor Supply very attractive at current levels, and it's 1.8% current yield, has only 23% debt, but it is not rated by S&P. My next research candidate is the iconic Walt Disney Company. The company offers a current dividend yield of 1.7%. It's available at a blended PE of 15.4, which I consider fairly valued. It's A+ rated, only has 27% debt. But I want you to see here this great lesson this particular offering teaches us in the importance of valuation. During the irrational exuberance, Disney's PE ratio got up to 64. And I want you to notice, had you held that stock all the way through February of 2009, we'll call that just about 9 years, you would have actually lost over 60% of your money and had a negative 8.8% annualized rate of return. This is the kind of situation that gets people to turn negative on the stock, but I also want you to notice that during this time frame, Disney was not really performing that poorly as an operating business. They did have some decent earnings growth, but more importantly, had you bought the stock in February of 09, which is obviously a great time to buy stocks, the Great Recession, and held it to today, even after the recent correction over the last couple of years, you'd have averaged over 22.7%. Valuation coupled with earnings growth and dividend growth is a critically important aspect. But going back to this high valuation we saw at the beginning here, the PE was like over 25 in the beginning. If we go back to September, which is a fiscal year for this company, of 1998, and held this stock all these years, even through that overvaluation period, I want you to notice it would have underperformed the S&P on dividends, but outperformed it thanks to the earnings growth on capital appreciation and total annualized rate of return. But in contrast, if I shorten this graph to a 15-year graph, where you have a much better valuation on Disney and then compare it to the S&P, it now outperforms the S&P on total income, almost double the capital appreciation of the S&P, and it significantly outperforms it on a total rate of return. So valuation coupled with earnings and dividend growth is the things that are going to drive your long-term performance. I think Disney is attractive at current levels. It's forecast to grow at 13.5%. Again, it's widely followed. This would indicate double-digit returns going forward, and the longer-term growth rate is still over 11%, which would still indicate double-digit rates of returns if it made all these earnings achievements that we're looking at here. My next research candidate is Lear Corporation, Auto Parts and Equipment. And I really appreciate the opportunity to share this one with you because I talked about this in the article. What do you do when the PE ratio is chronically below 15? Well, this is a classic example. I want you to notice this company has grown earnings at 17% a year, which created a theoretical fair value reference line of a PEG ratio of 1 or 17.7 times earnings growth. However, notice that the stock has chronically traded at about a 10 multiple. And this is the kind of thing, I don't argue with the market when I see this. What I'm doing is I'm analyzing what I'm seeing. There's obviously uncertainty in the minds of the marketplace and investors. The company's BBB minus rated, only has 30% debt. But the point is, the market only values this company at a 10 PE. But even then, we still see significant outperformance on capital appreciation versus the S&P. It's underperformed it on dividend income, however, but the total return here has been exceptional. But the key is you buy this at a 10 multiple, which is approximately where it's at right now. The current blended PE is 10.6, which is historically normal for this stock. My next research candidate is Open Text Corporation, application software company, BB plus rated, 37% debt to capital, offers a 1.5% dividend yield. However, it's only been paying a dividend since 2013. But notice here we have, again, we've drawn a fair value reference PE of 18.8, but we see that this is normally traded at closer to a 15 PE ratio. When we look at long-term performance, we see that it has dramatically outperformed the S&P on dividend income. It's dramatically outperformed it on capital appreciation and dramatically outperformed it on a total return. I think the company is very reasonably valued here. The real concern would be relatively low growth expected for the next couple of years relative to historical norms. But when I go out to the 3 to 5 year growth rate, there are 3 analysts that expect almost 20% growth or 19.7% growth. So if I combined the two, if I took the near-term estimates that we see flat and then combined it with the long-term growth rate, we can still see that this company offers the potential to generate very high long-term rates of return going forward. My next research candidate is Thor Industries, RV manufacturer is what it's known for. What I really like about this particular graph is I want you to see how closely stock price tracks earnings. We've got a growth rate of 17, so our orange line is a valuation reference of a PE of 17. Our blue line is getting back to that 15 PE that I talk about. But look how closely this company tracks that. Now, people argue about this all the time. I hear all these comments, but this is real. This is the real world. This is real history, and you can see that where earnings go, stock price follows. The company got moderately overvalued coming towards the end of last year. We've recently had a very nice correction in the stock. It offers a 1.5% dividend yield. It's not rated by S&P. However, it only has 4% debt. Looking to the future, there are 8 analysts forecasting this fiscal year, which ends in July, by the way, to grow at about 30% for this fiscal year, followed by 7 17% and 15%. The longer term growth rate is double digit by 2 analysts forecast to grow at 15%. So this is a great opportunity to buy this stock. A little bit of cyclicality during the recession, but you can see it's got a great long-term track record. It offers a moderate yield and has very, very little debt on the balance. With my final research candidate, I'm actually going to look at Pulte Group, the home building company. And this is really not a research candidate from my perspective. I'm showing this company because I've been asked about it by several people here recently. I want you to notice how strong this company grew going through the recession of '01 and how stock price tracked it. But then as we had this housing crisis and the Great Recession, etc., earnings completely disappeared, dividends completely disappeared. Over this period of time, this stock, and this is from peak to trough, would have lost over 90% of your money. That's a minus 31% annualized return. Now, however, as we look into more recent years, the company's earnings growth has been very nice and the price has tracked that. Track record performance over this time frame has been almost a dead heat with the market on a capital gain. Slightly less dividend income because it's not really paying a lot of dividends. But my concern about this stock would be what's going to happen going forward. So, you know, we've designed this research tool. I can go into the company's website here and look at presentations. I've got all these external links. I can go into sites like Seeking Alpha and I can look at, you know, what the company's currently doing and what's going on. But so, you know, the idea here is you've got to research these companies. It's not just about looking at these graphs, although these graphs give you tremendous insights, great historical views, as well as some perspective of the future going forward. But this is what can happen when you get into a highly interest rate sensitive and real estate sensitive industry like Pulte Group, which obviously is related to interest rates. This has been Chuck Carmel. I hope you've enjoyed this last and final version. I can tell you all one thing, I probably won't be doing 10 stocks at a time in future videos, but I hope you enjoyed what you've seen so far, and it's been my pleasure to present this 5-part series on valuation. Thanks for watching and reading.